Welcome to the cutting edge of the financial markets. This is JMSKULLZ Trading, where data meets discipline and precision. Get ready for a high-octane journey into market mastery. We build our structures on solid strategy and real-time analysis. Before we proceed, a vital reminder. Trading is a high-risk endeavor. Our content is strictly for educational purposes only. Trade responsibly. Never risk capital you cannot afford to lose. Always prioritize protecting your portfolio. Now let's watch the strategy unfold in the heat of the market simulation. From demand zones to structural shifts, we track every candle with surgical precision. Witness the power of a proven system as we hit our targets and secure the profit. Precision execution leads to consistent results. That is the JMSKULLZ way. Join a legacy of 5 years in the markets. It's time to level up your game. JMSKULLZ Trading. Learn, trade, and grow. Check out the link in our bio to start your journey today.
Now in this video, we will continue on the course content and the insight of liquidity. Right? This part is strictly liquidity, and this is one of the second important things I see for traders, and this is where most traders, not understanding liquidity, this is where most persons will say a participants of the market say that trading is a sham, a trick, because they are actually being a part of liquidity. They are actually sitting in the liquidity pool while waiting for it to actually be taken before making an action. So, in highlighting liquidity areas, you will understand where the traps are hidden, are sitting in the market. And if you would have watched my previous video on price action, you will recognize that a lot of things would then tie itself with liquidity and where the traps actually take place. So without further ado, let's dive right into it. The content we're gonna cover within liquidity, we have buy side and sell side liquidity, external and internal liquidity, liquidity reactions such as liquidity sweeps, liquidity grab, and finally liquidity run. So let's dive right into it, right? So liquidity. First, we have to understand what liquidity is. And liquidity refers to the availability of orders in the market that allows traders to buy or sell an asset quickly and efficiently without causing a large change price. In simple terms, liquidity is the availability of money or orders in the market. In liquidity in price action trading, in price action and smart money concepts, liquidity is often viewed as areas on the chart where a large amount of pending orders are located, where the traps are actually located. These areas usually contain stop loss orders, buy orders, sell orders, breakout entries, and limit orders. Again, traps are formed. Large institutions need liquidity because they require enough opposing orders to execute their large position. And in a sense, if you're a synthetic trader such as myself, you will actually be playing against the market maker itself. So whoever market or who's a market you're actually in a part of, such as big companies that have synthetic market, you have to understand that these are the areas that they have to tap out majority of its participants first. Because this is just like human beings. If you may have 500 people, 50, I can't pay all of them all at once. So I'm going to buy out some of them, cause them to be in some other problem, but they have to deal with some other situation, right? And then we have a minimum to pay. So I take out some of my orders or some of the persons who who are expecting cash from me so I can pay the minimum. So why does liquidity matter? Liquidity drives the market movement. It helps explain false breakouts. It improves trade locations. So the key takeaway, professional traders study liquidity. Large orders require liquidity to be executed. Price action moves towards areas with concentrated orders. Hence, liquidity helps explain market reversals, breakouts, and institutional price movement. Understanding liquidity allows traders to stop viewing price movement as random and start analyzing where the market is likely seeking orders and why price moves the way it does. Now, in understanding liquidity, you have to understand that there are different types of liquidity, and the different types of liquidity are found at different areas. And we have the buy side liquidity, and buy side liquidity is a collection of buy orders and stop losses located above highs. Alright? Whereas we have a sell side liquidity, which is a collection of sell orders and stop losses located below the lows. Alright? Price lows. Now here is a practical example. Now, in our previous video, we would have actually went through market structure and understand what support and resistance are. And in understanding support and resistance, it can also help us to understand buy side and sell side liquidity. Because buy side liquidity is resting where resistance is, while sell side liquidity is resting where support is. Alright? So it is much easier to understand and to locate using the support and resistance. And buy side liquidity and sell side liquidity can also be present at swing highs and swing lows in a current trend in itself. Now, understanding that we understand the external liquidity, but there's also another liquidity that we have to be mindful of, and that is the internal liquidity. So internal liquidity is found within the range, while the external liquidity is the buy side and sell side liquidity, which is found in the external regions of the area. So understanding the different liquidities helps to understand why a trade doesn't play out in the favor of yourself, why it actually stopped at that particular area, right? Because we didn't highlight the internal liquidity that can be drawn on and taken to be used as a reversal. Remember, all liquidity zones can be run on, while as used to cause a reversal in the market. So we have to be mindful of all liquidity zones. So here are some examples, some illustrations just to explain why the external and internal liquidity play a vital role in how our trades perform. In our first example here, we recognize that, let me get my organizer. So in the first example, we see that the buy side liquidity, where we have price pushing down, causing an internal liquidity to be formed here. It then sweeps this internal liquidity and then run upon the liquidity to push price to the external liquidity, which is also the buy side once more. After which price then push down to the internal liquidity once more, where it then gathers strength to push price to the maximum buy side liquidity and hence breaking the buy side liquidity. In our second example here, we have the inverse of this. Price sitting at the sell side liquidity, then pushing up, creating an internal liquidity, which then pushes price back to the sell side liquidity. Then the internal liquidity that was previously created over here by equal highs is then cleared, then used as fuel to push back onto the sell side liquidity to hence break the sell side liquidity. Alright? So this is a perfect example why you actually enter a trade from the very top to see play to go to the external, the other external liquidity in, but price just happens to break it within the middle and return prices back onto the energy. So these are two practical examples of why your trade don't actually play out how you like it. But 3 and 4, this is the ideal trading scenario that you actually want to see, where you can actually enter a trade from the buy side liquidity and see where it takes profit and to the second side liquidity. This is where your internal liquidity that would have played here would have reacted in your favor, continue to push price downwards, as well as in illustration 4, we have the internal liquidity playing a vital role where it is now being swept and help to push prices from the sell side to the buy side liquidity on a continuous trend. Now, this is the ideal trade that we would like to see, but most times we're not going to see this because price actually consolidates most of the time. It doesn't just trend continuously. So when you get that one-off trend, take it. Right? Now, liquidity. The three forms of liquidity movement in trading is very important, and I have to highlight them, right? Which is the liquidity sweep, liquidity grab, and the liquidity run. Liquidity is one of the most important concepts in price action and institutional style trading. Markets often move towards areas where a large amount of orders are located because those areas provide the necessary volume for large participants to enter or exit positions. Right? So the three common types of price reaction with liquidity is the liquidity sweep, liquidity grab, and the liquidity run. Although these three are sometimes used interchangeably, they describe different behaviors in how price interact. Now, we must understand what a liquidity sweep is before we can actually know how it looks. Now, a liquidity sweep occurs when price intentionally moves into an area containing clusters of order, taking that liquidity and then either reversing or continuing in the original direction. In simple, is when price clears a significant pool of orders before making its next move. Alright. Now here's an example of liquidity sweep where price breaks a swing high in this case, and you can see it broke it with a definite candle, not a weak candle itself. The body itself broke the high and then sharply reversed back into the zone. Right now, this is one of the traps that most market makers and institutional players play on retail traders to kick out retail traders before actually creating the initial move. And that one was a buy side liquidity, and now we have our sell side liquidity where the inverse of this happened, where a swing low would have been taken out with a bearish candle, engulfing bearish candle, and then rapidly returns back into the area with a engulfing bullish candle, right? Which would have then been another trap to take out sellers, to trick sellers to say that price is continuing downwards, but instead price came back into the zone. Now the next one that we're gonna actually speak on is liquidity grab. It is a short-term move where price quickly penetrates a liquidity area to trigger orders before sharply reversing. This is one for the reversal confirmations because it is tied so much with price action. Now, in simple put, a liquidity grab is a fast reaction of liquidity designed to trap traders before price moves in the opposite direction. As I said, it is one of the best reversal strategies you can use, the liquidity grab. Now, here's the example illustration of a buy side liquidity where price swing high is being taken out by a weak, a sharp move that went up and came immediately back into the zone, right? Causing price to push back down, causing a reversal. So price has not actually accepted to go higher than this point, so it came back into the zone. Whereas for the sell side liquidity, we have the swing low where price pushed aggressively down and then came back aggressively in that same candle to push price upwards, right? This is where price recognized that it cannot manage to go any lower, hence why it had to come back into the range to then play amongst price, which is high, right? Now, with a grab, a liquidity grab, and a liquidity sweep there, most times, as I said, interchangeable. One has a little difference because for a grab is a definite reversal, while as a sweep is a not per se a definite reversal. It can give a reversal as well as a continuation. So with that, we have to be mindful. Right? So that's why I had to separate it. Grab definitely tells me that I'm going to ensure a reversal trade, while a sweep gives me or tells me that I need to be more patient in how this trade actually plays out in whatever strategy you're using. No, liquidity run is one of the things that I would have said in our previous video, which would have been the ideal thing to see when trading, and also in this video, right? It's the ideal thing you want to see in your trading because you see price moving from one end of the liquidity pool to the next end, right? And this is what we would love to see in an ideal trade. Now, a liquidity run occurs when the price moves continuously towards a multiple liquidity targets, collecting orders along the way without immediate reversing. And as I said, this is what we love to see in trending markets, right? Especially price continuing in the direction that we want to see it moving. So this is one of the liquidities that is more ideal for traders in itself, retail, any trader, whatsoever. So here's our example on liquidity run. Now this liquidity level here would have represent any swing high, support or resistance, any significant key point of price. So it has to be significant, right? Now once price would have actually swept or actually done a little good sweep on price, retrace a little bit, and then it would run right through the level, which would have been a liquidity run, continuation on liquidity. All right, and this is one of the ideal things we like to see in our trades. Now, these are vital rules, and for me, the liquidity sweep, it just tells me to be more patient in my trade. Whatever strategy you're using, it just tells me that just to be patient just a little bit more to see what price is actually gonna reveal to you. While as a liquidity grab is just a definite decision telling me that it's time to take a reversal trade from here. While a liquidity run is one of the ideal things we want to see in a trade when our trade is active. Alright? So just to highlight these pointers, alright? Now, this is basically a lot, but you can replay the video and get a full understanding of what liquidity entails, alright? So, thank you for watching and see you in the next video. Peace.